President, for a long time, people opposed to climate action said that tackling climate change would be too costly, would harm economic growth, would be bad for American businesses, and would kill jobs. Turns out, these were phony arguments peddled by fossil fuel interests. Turns out, they're flat wrong. Turns out that actually the true economic hazard is not climate action, but climate inaction. We have recently seen an explosion of warnings from economic regulators, central banks, insurers, investment funds, risk analysts, that we face economic peril if we fail to address climate change. These are not green groups. These are neutral business and economic experts, the people whose job it is to protect us from risks to financial stability, the people who make a business calculation about what we stand to lose from unabated climate change. Their warnings are many, and their warnings are serious. One example, just last month, Moody's warned that climate change will increasingly disrupt and damage critical infrastructure and property, and will hurt worker health and productivity across the globe. Moody's, this credit rating giant, estimated, hang on, $69 trillion. We talk about millions around here pretty readily. We talk about billions when we're talking about really big money. $69 trillion of economic damage globally by 2100. Even if we limit global warming to only 2 degrees Celsius. The presiding officer and I are probably not going to pay a lot of that, but the pages will. And we're not currently on track for only 2 degrees Celsius. We're currently on track for around 3 degrees of warming, which, Moody's said, would put us at further risk of hitting tipping points beyond which lurk far larger, more lasting, and more ominous dangers. Here's another example. In May, the European Central Bank warned that climate change presents significant economic risks to the economy, to asset values, and to financial stability. The longer we wait, the longer we fiddle around in this chamber not doing anything, the more it will cost to protect ourselves in the future. That old saw about a stitch in time saving 9 applies here as well. The ECB said that these risks could cause what they called systemic issues. Systemic issues, especially where markets do not price climate-related risks correctly. Systemic issues. That's a bland term. It's central banker speak. What it means is something pretty serious. Systemic issues means this is so bad that it could take down the entire economy. And the European Central Bank is not alone. The Bank of England has been warning of systemic risk from climate change, or from not doing anything about climate change, for some time now. I think we're now over 30 sovereign banks who have made or adopted such warnings. Just last week, Senator Schatz asked Federal Chairman Powell whether severe weather is increasing due to climate change. Powell did not equivocate. He said simply, "I believe it is, yes." That's the leader of the most influential bank in the world, accepting without hesitation a major threat to our financial system, echoed also by a Federal Reserve report out of California. Climate change, they point out, is a major threat to our financial system, to everything from coastal real estate values, which Freddie Mac predicts will crash, to stock market share prices, about which there are numerous adverse predictions if this goes unchecked. America's biggest financial institutions see what's coming. In the House Financial Services Committee hearing in April, CEOs from 6 of America's biggest banks agreed that climate change is a serious risk to the financial system. They said they're trying to take action to address that risk. There's an unfortunate sidebar, however. Big American banks that claim to support climate action include 4 of our biggest banks: J.P. Morgan Chase, Wells Fargo, Citi, and Bank of America. These banks all supported the Paris Agreement. In 2017, the CEOs of J.P. Morgan Chase, Citigroup, and Bank of America even signed a letter urging President Trump not to withdraw from the Paris Agreement. These banks are all trying to reduce their own emissions, and all have commitments to get to 100% renewable electricity. All good steps. But the biggest direct impact these banks have on climate is not through the promises they make, but through the investments that they make. On that score, these 4 banks are steering us to climate calamity. A group of environmental organizations released a report in March adding up fossil fuel financing by 33 large private sector banks from around the world. These 4 American banks, J.P. Morgan Chase, Wells Fargo, Citigroup, and Bank of America, which all support the Paris Agreement and are all reducing their own carbon emissions, they are the 4 largest funders of fossil fuel projects. Combined, they invested over $580 billion in new fossil fuel projects over the past 3 years. J.P. Morgan was the worst, with $196 billion of fossil fuel funding in 3 years. J.P. Morgan was also the top U.S. funder of tar sands, Arctic oil and gas, and coal mining, the most emissions-intensive fuels. The big American banks accounted for over 1/3 of the surveyed global fossil fuel financing since the Paris Agreement was signed in 2015. And worse, their investment in fossil fuel projects actually increased after the Paris Agreement. Wells Fargo nearly doubled its fossil fuel financing from 2016 to 2018. Obviously, these investments in new fossil fuel projects do not align with the bank's stated support of the Paris Agreement. The math doesn't work. The Paris Agreement aims to limit warming to well below 2 degrees Celsius and to try to limit warming to 1.5 degrees Celsius. A study just published by Nature shows that the world's existing fossil fuel infrastructure will emit enough carbon pollution to blow us past 1.5 degrees of warming. The authors wrote that little or no additional CO2 emitting infrastructure can be commissioned. Little or no additional CO2 emitting infrastructure can be commissioned if we are to meet the Paris Agreement climate goals. And I'd ask unanimous consent that this article, How Much Global Warming is Fossil Fuel Infrastructure Locking In, from Inside Climate News, be appended as an exhibit at the end of my remarks.
Without objection.
Thank you, Mr. President. So that's the math. If the banks are true to their stated support of the Paris Agreement, they should not finance any new fossil fuel projects, unless, of course, they also finance capturing all the carbon emissions. And they're not doing that. It's true that these banks have announced goals to increase their financing of clean and sustainable projects, but they are only goals. And combined, even their goals only amount to around $100 billion per year, which is about half of what they actually invested in fossil fuel projects each year since Paris. Citi even released a report finding that maintaining our current fossil fuel heavy economy would cost more than moving to clean, low carbon economy. Costs more to stay in the fossil fuel economy than to move to a clean energy economy. And they said, that's not including factoring in the economic damage from climate change, which Citi reckons could total $72 trillion. $72 trillion under business as usual. So Citi projects that transitioning away from the project they're investing in to a low-carbon economy will save money on its own, and it will help avoid tens of trillions of dollars in further economic damages. And yet, they aren't investing consistent with their principles. According to the International Monetary Fund, fossil fuels are subsidized to the tune of $650 billion per year in the U.S. So there's no question that this massive subsidy, probably the biggest subsidy in the history of the planet, makes investing in fossil fuels profitable. But the contradiction remains. These banks all say they support the Paris Agreement. They all recognize that it is economically vital to reach the goals of the Paris Agreement. Yet, their investments would ensure that the Paris Agreement fails. It would help banks change their ways if companies had to disclose their climate risks better. I just joined Senator Warren in a bill we have done to require publicly traded companies to reveal their exposure to climate-related risks. But we have a proposal, Senator Schatz, Senator Heinrich, and I, to help resolve the very root of the bank's contradiction, that Congress put a price on carbon emissions and an end to fossil fuel subsidies. Indeed, J.P. Morgan Chase CEO Jamie Dimon recommended this recommended this in the House Financial Services Committee hearing in April, asked whether his bank will phase out fossil fuel funding and align its investments with the goals of the Paris Agreement. He said, and I quote, "If you want to fix this problem, you are going to have to do something like a carbon tax, a price on carbon." So, bankers, help us do that. If these bankers think climate is a serious problem, and they say they do, and that putting a price on carbon pollution is the solution, which virtually every economist agrees with, hello, you need to come here and fight to make it happen. Banks have political influence. Lord knows they never stop throwing their influence around here when it comes to financial regulations or tax giveaways. Where are they in Congress on climate? It's a long pause waiting for them to show up. So, guys, talk is cheap. Come on. Put a little effort into this. Pretend it's a financial regulation. The carbon fee bill of Senators Schatz and Heinrich and Gillibrand would help these banks align their investments with their stated goals. Our bill meets the key standards of being effective on carbon emissions, driving far more emissions than the Obama Clean Power Plan, far more reductions than the Clean Power Plan, revenue neutral in the economy, and border adjustable for trade. Meets all three. Plus, it will help avoid the dreadful economic warnings now so frequently heard from very responsible sources about doing nothing. Warnings of coastal property values collapsing, warnings of a carbon asset bubble crash, even warnings of big storms breaking the bank of the insurance system. To Citi's credit, it is a member of the newly formed CEO Climate Dialogue Group, which will, I hope, become a strong advocate for a federal price on carbon pollution. That is the place where essentially every economist, huge numbers of Nobel Prize-winning economists, many Republicans, former economic advisors to presidents, former Treasury secretaries, former EPA administrators, former members of Congress, have all come down. It's pretty clear what the solution is. It's a price on carbon that's revenue neutral and border adjustable and will reduce emissions enough to keep us under 1.5 degrees. That's not hard to figure out. It's getting there that's hard. Because so far, the net pressure of corporate America in Congress remains hostile to climate action, whether from indifference by companies themselves, or worse, from the hostile presence of corporate trade associations like the U.S. Chamber of Commerce and the National Association of Manufacturers. Two leading business lobby groups recently outed as the two worst climate obstructors in Congress. Last I checked, a clean and green economy involved a lot of commerce, and building a new clean grid and new clean technologies, whether wind or solar or batteries or storage or distributed generation, was a lot of manufacturing. We still await the explanation from the U.S. Chamber of Commerce and the National Association of Manufacturers why they are 100% aligned with the denial and obstruction of the fossil fuel industry and 0% aligned with their membership, who in many cases are leaning in to climate action. And there's a separate flotilla of front groups doing the dirty work of the fossil fuel industry. The fossil fuel industry doesn't want to show up and identify itself as the fossil fuel industry, then the game is too obvious. So they put up all these front groups with ridiculous names about heartlands and heritages and famous figures, and they're front groups for fossil fuel. And all those groups add to the corporate pressure against climate action from the Chamber and from NAM. So, for banks like these, who claim to take climate change very seriously, it would really make a difference if they would take an interest in climate change, not just on their websites, not just in their talking points, but in their investments in the market and steered away from fossil fuel and into clean energy, and in their influence here in Congress. Because we have to crack this nut here in Congress. There is no pathway to avoiding climate calamity that does not require Congress to act. Congress must act if we are going to get ahead of this problem. It's not optional. You can't shrug as a business leader who cares about climate and say, no, we're just going to do our thing. We don't need to worry about what happens in Congress. There is no pathway to avoiding the climate crisis without action in Congress. The fossil fuel industry knows that. That's why they're here, red in tooth and claw. And the sensible, honorable parts of the business community that want to do something about climate change need to show up and push back, because otherwise the hydraulics are against us. At this point, the science is clear. The economics are clear. The warnings are serious, systemic risk, and they are many. Neither our planet nor our economy can afford massive investments in new fossil fuel projects. Not by them, not by anyone. Time is short. We can no longer afford corporate America to be AWOL on climate in Congress. It is time for these banks and the rest of corporate America who wants to see progress and avoid what all those warnings are telling us, to wake up and to show up. Thank you, Mr. President.